Our market monitor tonight says now is not the time to plow large sums of new money into stocks. He's David Katz, Chief Investment Officer at Matrix Asset Advisors. David, you sound pretty cautious. Do you buy into what Dominic Chu was reporting earlier in our program about the warning signs that are out there in the markets?
Well, we don't think there are warning signs per se. We've been very bullish all year. We've been upbeat about the market. We've got a lot of the returns. With stocks up 25%, we don't think now is the time to get renewed optimism. Now's not the time to be doubling down your bets. Our best guess is stocks are going to end the year higher. It's going to be a good fourth quarter. We're upbeat about next year. But if you're looking to put new money to work, we would put it to work during sell-offs when the market is getting spooked by something. Like the last few weeks, you had a 4 or 5% sell-off. We would buy into that, and we wouldn't be chasing the rallies.
All right, you have a couple of stocks that you're recommending. Maybe they're the ones that you buy when the market dips down a little bit. Let's start with the first one, Capital One Financial. Why do you like this one?
Well, the stocks that we're going to talk about generally haven't done as well as the overall market, so we're pretty comfortable buying them here. Capital One has underperformed the overall financial group and credit card group in the last year in terms of stock performance, but their business has actually been doing much, much better. Credit trends have been very good. It sells at under 10 times earnings, and management has made a renewed commitment to shareholders to return dollars to shareholders through buybacks, through a higher dividend. We think they're going to be very focused on shareholder value, and it's one of the cheapest credit card and financials out there in very good shape.
And your next one sounds like it sort of fits into that same formula, Cisco Systems, which has slipped recently, although it's been up for the year. It's now trading at $22. Why do you like Cisco?
Well, Cisco has done nicely for the year, but they've given back a lot in the last few weeks. The sentiment has turned from positive to very negative. Right now, the stock sells at about 10.5 times earnings, pays about a 3% dividend yield. We think they have a good long-term future. The next quarter might be a little bit difficult, but at 10, 11 times earnings with nice earnings growth over the next 2 to 3 years, we think it's a good company, very good entry point. Our target is in the high 20s. We think on the downside, maybe you have about $20. So you have about $2 of downside, $8 to $10 of upside. We think that's a very good risk reward.
All right, let's talk a little bit about McDonald's, because investors were a little disappointed in their earnings report, quarterly numbers that came out this week. It got as high as $103 just a few months ago. Why do you like McDonald's?
Well, in fact, if you listen to that investor call, the analysts were pretty hostile toward management. The company beat earnings by a penny, but their revenues were a little bit light. They gave a lackluster outlook in terms of same-store sales trends. Having said all that, they pay a 3.5% dividend. They sell at 15.5 times earnings. We think in a better global economy, a better European economy, a pickup in the United States, business is going to pick up. And at this price, it's a very good way to play a market that has done exceptionally well this year. This is one that hasn't participated. If the market sells off, McDonald's should hold up real well, and we think should make pretty good money for you. All
right. One more, Qualcomm, another tech stock. What's the story here?
Qualcomm is a play on the new technology. Their wireless devices, they provide the guts to phones and to iPads, to wireless phones and to iPads. It sells at about 15 times earnings. Management is very focused on enhancing shareholder value. They're paying more and more out in terms of a dividend, buying stock back. It's at a very good price. We're indifferent whether Apple wins the game or Samsung wins. Qualcomm is providing chips to both of them.
To both of them. And it was up quite a bit today, $68. Do you have a target on it?
Our target's in the low 80s, but we think longer term it even can do better than that.
All right. Any disclosures, David, on any of these stocks?
We own all of those stocks. We continue to buy all of those stocks.
All right. Fair enough. Thanks so much, David. Have a great weekend.
Great to be here.
David Katz, Chief Investment Officer at Matrix Asset Advisors.